Silver closed Friday at $80.45. Remember that number? It's not the end. It's the setup. The mainstream says the drop is over. They're wrong. This Friday marks a rare convergence of 5 market conditions. Each one alone is significant. Together, they are historic. Last time this happened, silver jumped 38% in 6 weeks. I'll show you exactly how it happened. Stay until the end. The 5th point is critical. I'm the Asian guy, and I cover silver markets with forward-looking data, not reactive analysis. If you want to see the market before it moves, this is the place. Silver peaked at $90.39 on March 10th, then it dropped to $79.35 intraday on March 13th, closing at $80.45, a $10 drop in 3 sessions. Painful, yes, but the reason matters more than the price. Was it a fundamental supply-demand change? No, it was mechanical. The drop was triggered by technical positioning. Retail traders piled in at the golden pocket. Institutions were ready. Shorts hit, and $10 of equity transferred to institutional hands. Nothing about physical silver changed. Inventories remained the same. Deliveries stayed unchanged. The Shanghai premium persisted. Global production deficits continued. Only the paper price moved. That distinction is key, because the market is resetting, not broken. And resets in a bull market are where the next phase begins. Total COMEX silver inventory is 341.72 million ounces. That's a 12-month low. 1 year ago, total inventory was 531.87 million ounces, a decline of 35.7%. Registered silver stands at 78.95 million ounces. Open interest is 115,026 contracts. Each contract represents 5,000 ounces. That's 575.13 million ounces of paper obligations. The registered leverage ratio is 7.28 to 1. For every ounce of physical silver, 7.28 ounces of paper are promised. In 30 days, total inventory dropped 9.22%. At this pace, we approach forced delivery levels in months. This is called a supply squeeze, and it's already in progress. The paper price is temporary. The physical vault is permanent. Meanwhile, UK 10-year yields jumped 50 basis points in 2 weeks. Germany's 10-year bond yield reached 2.95%. Germany's manufacturing sector has contracted 18 months straight. Inflation is rising, growth is slowing, central banks are trapped. Negative real rates make silver almost free to hold. Purchasing power preservation becomes cheaper than cash. European yields signals stagflation. Energy costs feed into 45,000 products globally. That creates a rolling wave of inflation. Silver sits at the intersection of inflation and industrial demand. It's an industrial, monetary, and hedging asset simultaneously. The paper price is $80. Shanghai silver trades at $94, a $14 premium over COMEX. The Shanghai curve is in backwardation. Buyers pay extra for immediate delivery. It's a physical market distress signal. Demand cannot wait for normal futures delivery. COMEX is leveraged. Shanghai is anchored in reality. The gap must close. Either New York moves up or Shanghai moves down. Physical supply determines the outcome. And the speed of the move depends on physical buyers. They are indifferent to the paper price. Every delivery contract is an arbitrage opportunity. Now, timing matters. The Fed meets this Tuesday. The dollar index just broke 100. Historically, 100 has acted as a ceiling. 3 approaches to 100 reversed in 12 months. Dollar above 100 tightens U.S. and global financial conditions. Exports become uncompetitive. U.S. multinational earnings fall. Inflationary pressure persists. The Fed knows this. 2 pathways emerge. Path 1. Fed signals concern over growth. Dollar reverses. Silver recovers proportionally. Path 2. Fed does nothing. Dollar pushes to 102 to 103. Silver tests mid to low 70s dollars. Both are possible. The difference lies in Fed interpretation of data. Q4 GDP came in at 0.7%. Consumer sentiment is 55.5. 1-year inflation expectations rose. Weak growth and rising inflation point to stagflation. Market probability for a rate cut is under 5%.